Hey everyone, welcome back to Fiscal Voyage. My name is Felix, and today's video we're going to talk about a semiconductor stock that's undervalued to fairly valued in today's market. This stock has a low yield. The growth potential is very good. You have the potential to make 11% or so annually, and I'm going to give you guys a reason that I'm actually going to hold off a little bit. Look at that towards the end of the video in the technical analysis, and I'll show you why I'm holding off right now until I have a price that I really like. But today's video, we're going to talk about the semiconductor. So make sure you hit that like button, and if you're new to the channel, make sure to hit that subscribe button. So let's get started with the video. Dividend stock that's undervalued right now, or fairly valued, either way, and I'll show you why I have that fair value to undervalue area, and we're going to look at it here. You see right now it's going for $154.12. The current dividend yield at 1.43, so it's not a high dividend yield stock. This is more a high growth stock with the potential of dividend increase, of high dividend increase. So it's kind of that low dividend yield with high dividend growth, right? So we're always trying to look at that happy medium, 3% with a 3% dividend yield with a 7 to 8% dividend growth. A stock like this, with the 1.4% has the potential to increase, 15, 20% every year in dividend increases. But anyway, if we look at the fundamentals here, earnings are expected to be $11.57, giving a P of 13.5. Considering that it's a semiconductor, a technology type of stock, this PE ratio is very low. A lot of technology stocks are going with PEs of 20, 30s. So this is very low PE ratio. And you can see here the dividend rate is only $2.24. So the earnings cover the dividend rate very nicely, almost 4 times. But anyway, if we go to the fast graph, you can see here, if we make this bigger, you can see the company has been growing earnings every year. There's been years where it has some downtime, but overall, in the long-term picture, the company stock or the company earnings has been growing. And that's what we always like to see. Company earnings continue to grow year over year. And this allows the company to increase the dividends and as well as the share price to follow the earnings. So if we see here, in 2019 and 20, earnings dropped 15% in 2019 and 1% in 2020. But because you guys all know the semiconductor shortage and all these things with semiconductors, the earnings for 2021 was $10.50, which is a 71% increase in earnings, which is outstanding. That's what drove this price from as low, from COVID low as $80 all the way up to almost $200, $190. So that's crazy. So we have a pullback. You can see here that $200 area or 190 area. And I'll show you in the technical analysis shortly in this video, but that has strong resistance. And that's what caused the price to then finally pull back into the 156 area. So you can see earnings are expected to continue to grow at a double-digit rate at 10%, 11%, 10% in 2022, and 11% in 2023. So still has double-digit growth. And if we show in this time period to the past 7 years, adjusted earnings is growth at 11.2%. So that's still great. And if the companies continue this trajectory, we have a potential total annual return of 10.8%. So that's not tremendously great annual rate of return, but a decent annual return with a safe dividend. The only problem with this company is the dividend track record is only go back to 2014, but as you can see here, it's been growing it very strongly. You can see here almost 200% in 2015, 63% in 2016, slowed down slightly in 2017, but in recent years it's been over 15%. 2021, 13%. But I totally see this company growing it at close to 20% dividend rate. So this dividend yield on cost is going to be much higher if you were to buy it now, and say in 5 years it's probably yielding 3% or 4%, with this continued growth and the growth of the dividends. So just because it has a low yield now, you just got to wait, be patient for it, and the dividend growth will catch up, and with yield on cost, you have it 3 or 4%. But anyway, if we show in the time period here of 9 years, you can see the company has a normal PE of 14 14.8, and right now is at 14.4. So it's undervalued slightly. Again, that's why I mentioned earlier that it's slightly undervalued to fair valued, but still it's a tremendous company. And semiconductor is not going anywhere, right? It's going to be here for us forever, because we're going to need chips, technology in the cars or whatever. Anything is going to be connected to the internet, so they need, some the semiconductor materials and things like that. And we go to Morningstar. Morningstar gives this stock right now a 4-star rating out of 5, which is a buy recommendation. And they have a fair value price at 210. And right now it's at 156. This was from yesterday, so it's actually lower today at 153. And it's a narrow moat. And one of the things I like is that their debt is very, very low. You can see here debt to equity at 0.45. I like to see this at 1.5 and lower for a good debt equity ratio, and this is really very, very low. So I like that a lot. Some other valuation we're gonna look at, price to earnings. The 5 years average is 5.4. Right now it's at 5.10. Or price to sales, excuse me. Price to earning is 17.4 versus 20. And the price to cash flow is slightly higher than the 5-year average, and price to book is slightly higher than the 5-year average. But overall, that's what I'm telling you, is kind of like fairly valued, it's slightly undervalued. It's not a great potential of return at around 10 to 11%, maybe even 12%, but still solid company. Is something that definitely interested in getting into. And if we look at the technical of this stock, you can see here, right there, I'm gonna draw a line for you guys. Right here is where the resistance is. You see here, boom, it dropped it down at around $200 or 197. It broke all the way as high as 203, so it did break that 200 level. And with that break, I expect this stock to eventually get back to the 200 level and continue higher from here. But for now, it is on a pullback. It created a lower low. You can see here, it should have bounced right over here. If we make a line right there, it should have bounced right here like it did before, but it didn't. It went lower, it pivoted higher, and then it created a new lower low. So now it's in a downtrend. So what this does is it gives us a potential buying opportunity. So let me delete that one here. And this is where I personally would love to buy a lot of shares right here, and from the 140 to 130 area. I think this is going to be a great bounce area. But right now, you could definitely nibble some shares. So say, for example, you wanted to invest $1,000 in this stock, right? If you wanted to nibble, invest maybe $200 or $300 of your $1,000, right? So you're in the game already at a decent price, as I showed you earlier through the fast graph. And the Morningstar gives it a buy rating with a $200, 210 fair price value. So if say you had $1,000 to invest, you could buy, $200 shares of this company. You're not going all in at this price. And if it does reach this $140, $130 area, you could buy more shares, because what happens if there's a market correction, right? And then it'll drive this down, and it's in a downtrend. It hasn't broke this trend line here. That's why I put that there. So the potential, it goes right here up to here, and then start creating a new lower low and give us a better opportunity at $140 to $130 to buy more shares. But definitely, if you were interested in this stock, buying shares at the current price with a say, again, if you want to invest $1,000, you could put in, $200 or $300 and see what happens. And if it goes higher, okay, you don't buy no more. You just let that $200, ride and just watch it and things like that. But if it does, now you have an opportunity, you have $700 left or so to buy more shares at a much, much better price. Right now, the price is fair to slightly undervalued, so you're still getting a decent price. But this 140 to 130 area is where, I'll probably go, in onto the shares. So, I personally am not going to buy at this level because the dividend yield is very low. And I think the market is going to correct a little, but that's just my opinion for now. But definitely, I have alerts in this price range to buy more shares of this stock, because you can see here, it's expected to grow very nicely, double-digit return or earnings growth for the next few years. And with that, even at today's price, you see you have an almost 11% annual rate of return. So this is solid company. is a stock that I eventually gonna own in my position. But till then, we'll see what happens. All right, guys. So thank you for watching. If you enjoyed this video, make sure you hit that like button and subscribe to the channel if you're new to this channel. And God bless, and Jesus loves you.